Can you walk us through, you've done, 25 deals. Walk us through maybe like maybe a traditional search and then a self-funded search. What does it typically look like, the terms with investors and the entrepreneur, and just maybe kind of some averages? It doesn't need to be specific.
Yeah. So, the beauty of traditional search is it's basically a set formula. It's all line kind of across, even the US and internationally. About 50% of what I've done is international search. And the formula is basically you invest in the search, and that capital can be like 400 to 700,000 if it's single or double, and it funds that search for 2 years. That money, when a deal closes, is then stepped up, so that 400 becomes 600 and put into the deal, if that makes sense. So that kind of translates into the deal. And then the searcher is usually gets up to 25% in basically a third instrument. So they get 8% to make it simple, 8 1/3 for closing the deal. That's kind of like the finder's fee. Hey, you got the deal, you got your 8%. So even if you left, 6 months later, you got the 8. The second 8 is time vested over 4 years. So kind of classic, time vested over 4 years. And then the last 8% is based on a hurdle rate of 20 to 35%, where you get the remaining part of your equity. And it's 25% if it's solo, and it's 30% if it's two. So that's kind of the general frame of how that works. And then I'd say I'll kind of go 3 ways. In independent sponsor land, which are kind of these large non-SBA deals, there's usually a finder's fee. So these people are, they're not paid to search. So often they're kind of former private equity folks or operators in the space that maybe they just did a vet roll up as part of a PE fund. Now they want to do their own. And so they aren't paid to search, but when they have a deal, they usually get a transaction fee. It's like 1 to 2%. They usually get an EBITDA monitoring fee. So on the hold period, they usually get, say, 4 or 5% of the EBITDA. And then there's usually a hurdle, and then say like 20% above that. So that's kind of how those independent sponsor large deals work. And then on self-funded search using SBA, those deals honestly range a ton, and it's kind of a little bit of the wild west. But generally, what I see are kind of a couple rules of thumb. So, I have like a template for self-funded search. I'm happy to share the Excel model to kind of help model this and kind of what you think would be fair. I generally recommend basically the searcher, the investor should basically model at a 35% IRR. So that's the top tranche of traditional search. So you should model there in a base case in self-funded search. And base case is same entry multiple and exit multiple. So assuming kind of the same multiple, same growth rate as the past. So it shouldn't go from growing 1% to 20. So it's basically base case, standard base case. And it should model there, and it should get there pretty easily, partly because self-funded search has a lot more debt. So it's usually 80%, 90% debt. And then you're usually buying at lower multiples. So you're buying at 4 or 5 times. Once again, why it should model so high too is also these are much riskier assets. The smaller the deal, think about it, a smaller deal with a lot of leverage is inherently pretty risky. Some other rules of thumbs as you kind of build out the economics for the investor are generally it should be kind of a 3 to 5x MOIC, or kind of return on capital in 3 to 5 years. So that will align with the IRR, but just in case, some people IRR is time based. So if you kind of play funny games with IRR, you want to make sure it still hits on the MOIC hurdle. And and it's usually done in an instrument that's a preferred rate of return that converts into common. So that preferred will be like at 8 to 15%, and then the common is usually 20 to 50% to the investor. So usually the searcher's owning the majority of the economics on a self-funded search deal, assuming it's in that kind of $3 to $7 million range and and they're using the SBA debt. So in those deals, the searcher's taking on the debt, and that's part of the reason they're getting larger equities. They're taking on the personal guarantee.
Well, I think based on a couple of those breakdowns, right, you could see the pros and cons for both. If you're going to the traditional route, you typically have a salary, you've got investors already lined up. You're only going to end up with a smaller portion of the business, but at the same time, you're typically not taking on a lot of the debt personal guarantee. On the independent side, you're typically doing much larger deals, and that's probably mainly for people, former private equity folks who probably aren't listening too much to this podcast. And then on the flip side is the self-funded, right, which is similar traditional, but you don't necessarily have investors lined up. You're kind of on your own. You're funding it all yourself, which allows you to have a lot more upside, but you're also taking on a personal guarantee. And so I think when a searcher or an entrepreneur is trying to figure out what works for them, part of it's understanding their own risk tolerance, their own, runway, if they've got enough money saved up to be able to do it themselves. And then of course their network of investors and which path they want to go down. And so I don't think there's necessarily a right path. I think there's a right path depending upon the person. And so based on the pros and cons and how things can go, it allows the entrepreneur to kind of pick a path that makes the most sense for them.
Yeah. I think they're both interesting paths. I think traditional, my simple is like smaller piece of a bigger pie with world-class investors. So kind of generally a higher caliber of folks you normally wouldn't get on a large deal. And then you're also, it's different being a CEO of a 20 or $50 million, just kind of depending your career ambition. So it's just a different job in generally kind of a more ambitious way. And then self-funded is you're not paid to search and you're getting a larger piece of a smaller pie, generally with kind of less involved kind of high-end investors. But, you run the show too, right? So it's a little bit more kind of in your freedom and well, so just a little depends. And I've seen traditional searchers. Some folks have done a traditional search and had success, then did a self-funded search. I've seen traditional searchers then do another traditional search. I've seen self-funded searchers who have done multiple self-funded deals. So there's all a bunch of varieties around it.
And it sounds like, if you've got people going back and doing the same one or changing it the second time around, it just depends on, the period of life that you might be in or the skill sets that you're trying to build, or, sometimes you're trying to optimize for maximum exit. And other times you might be optimizing a little bit more for lifestyle, just based on, if you've got a family and kids and those types of things.